9, and then the other one will be period 18, the settings. Okay, if you don't use those settings, you won't get the exact reading. So you should make sure that the method is exponential and not simple. And then also the other one will now be period 18. Then for bias for new members, it's trying to predict whether the candle will be red or will be green on the daily time frame. Okay, here where each candle shows where price moved in a period of 1 day, with the price on the right side there. So if it's a red candle, a bearish candle, within that day price will have an overall downward movement, and taking sell trades with a bearish bias will give your trades better momentum and better profits. And I actually explained more of it in the other videos, which you can check. Now for the backtest results that I gave you in the group, okay, I backtested from end of April going backwards, and I was only able now to record 24 trades when not recording trades of NFP week. It was only one trade, which was during the NFP week, which was a loss. But for those without the NFP week, it was 24 before we get to end of 2020 where there are price gaps. Remember, I told you not to backtest from 2020 going backwards for stock indices. The price gaps sometimes can cause unexpected changes in trend on the daily time frame. Again, and if you see this video, also read the notes on institutional liquidity. Those notes will actually also assist you. So here I'm putting this red vertical line to show where the downtrend would end when I'm backtesting from here going backwards. Okay, remember when you are the period 9 and period 18 exponential moving averages, they don't just show trend but institutional order flow, which is an overall direction where banks will usually be driving price. So when they cross and then they are now looking as if they are opening away from each other, you would then record your sell trades, or even when trading you would then take your sell trades only. That will give your trades better performance. And then when they cross again like this, you would then stop taking the sell trades. And then when they would have crossed and then they begin to open away from each other, you would begin to take your buy trades going there. And now since it's a downtrend like that, it means that we would also be looking for bearish bias. And when also you would have found bearish bias, you would then focus on your sell trades only. Okay, so my calendar is now responding, so I'm now going to the most recent trades, and then I'm not going to backtest all the trades. I'm just going to see if I will be able to get maybe about 10 trades or so. So July, this was NFP week. Okay, first Friday of the month of July, you wouldn't take a trade there. With this strategy, don't trade in the NFP week, even on the Tuesday. So the previous week in June, the Thursday to Friday will be 30 to 28. Okay, so here you would be focusing on sell trades right now. Okay, and the date, you can see the date and time, it will appear down there. So that will be the 30th. So I'm going to also check and backtest the other indices. I had not yet tested the other ones. So remember, this is a downtrend, and now I'm going down to the 15-minute time frame to look for buyers. Okay, it jumped to another date. And I also forgot to tell new members, sometimes going from the daily time frame straight down to the 5-minute time frame can be a problem. Okay, it may sometimes bring you into another date, although it will be closer. But if you go down from the daily then to the 15-minute time frame, then from the 15 you then go down to the 5-minute time frame, you shouldn't have a problem. Okay, and I'm zooming out. So for this strategy, for US 30 index, New York bias method is the one which responds better. Remember, there are two methods for bias: the New York bias, which I gave you, and then the London open bias. The London open bias is where I said that on the 15-minute time frame, you check 4 candles, which will be the first hour after the London open session. London open will be from 2 to 5 a.m. EST. If you add 4 hours on those times, that will be 6 to 9 GMT, which is MetaTrader, the one which we use here for backtesting. Then in Zimbabwe and South Africa, if you add 2 hours on GMT, that will now be from 11 a.m. to midday. So from 9 GMT there to about 9:45, these 4 candles, you can see it's an overall downward movement. You would see that is a bearish movement, but we are not using London bias on US 30 index. It responds well to the New York open bias method with about 81% success rate. It responds poorly to the London open bias. You should make sure that you are using the method which responds well. If they respond at least with about 70% or more, it's okay. And then for the US 500 index, where both methods respond but the other one responds better than the other, if you see that mixing both biases does not produce really good results for your trade, only record backtests using the one with the stronger bias. Okay, because it will be more accurate on predicting days which are in the direction of your favor, where you want to take your trades, and that actually improves the performance of your trades, because now most of your trades will have momentum within your favor. So for the New York open bias, for new members, you look at the 4 a.m. GMT candle, which is beginning of midday in New York, beginning of day in New York. Okay, so the open of that 4 a.m. GMT or the beginning of midday, because New York is 4 hours behind GMT time, the one on MetaTrader you are seeing here. So from there, if the close of the first candle on the 15-minute time frame of the New York Open, not the London Open now, but the New York Open. If the close is lower than the open of the New York day, most of the times it will be a downward day, it will be a bearish bias. But if the close of the 12:30 GMT candle or 8:30 EST New York candle or half 2 p.m. Zim time CAT candle, if it would be above the open of the New York day, most of the times it will be a bullish day. But that is only if the New York bias responds well to the instrument. So you usually, for me, I test about 22 days in the same direction of trend to see which one responds better. So with the New York bias, this would be actually be a sell day. So now I am zooming in, and then I'm now going to the 5-minute time frame, which is where you would take your trades. Okay, so remember, for the strategy of the index lunch hour, the lunch hour in New York, from 12 midday to 1 p.m. in New York EST, the lunch hour of the index markets, the price goes in the opposite direction of bias, opposite direction where the daily time frame candle will be going, and the price will be trying to take out liquidity of people who were profiting in trades from the morning session. And for those who were trailing their stop loss, especially too tight, price would then close their trades by hitting their stop losses. And for this day, there actually is an okay, let me see. Okay, there isn't any nearby highs. Let me go to the next day. Okay, it was 30 to 28. Okay, so I'm putting the line on the open of the 4 a.m. candle. Remember, for candles, for green candles, this will be the open, then price goes down to form the low on the lowest part of the green candle, then it goes up to the highest point of the candle to form the high, and then gradually goes lower and ends up at the close. And then after the time period, which in this case it's 15 minutes, for 15-minute time frame, it would then move to the next candle. Then for red candles, using this one which has a wick as an example, price would open and then gradually go up to the highest point of the candle, and then gradually come down to the lowest part of the candle. And then I'm now using this example since this one has a wick at the bottom and this one doesn't. After it would have come down to the lowest point of the candle, the low, it would then increase and then end up at the close of the red candle, or on that candle that would be the close, that one. So now I'm going down to the 5-minute time frame. Okay, so here on this day, from the lunch hour, the index lunch hour, price did not take out liquidity which was previously available before the lunch hour. This is the index lunch hour. Okay, let me move it to this candle. 4 p.m. to 5 p.m. GMT, or 12 midday to 1 p.m. EST. In Zim time it will now be 9 to not 9, it will now be 7 to 8 p.m. So the previous liquidity, these highs, okay, price did not go above those highs in the index lunch hour. Now price was coming down, and then retail traders, as price would continue to go down, they would lower their stop losses there. Now for new members, remember, where you put your stop loss when you are in a sell trade, if price goes back to that stop loss, your trade will be closed in a loss. But if you are lowering your stop loss as the trade is going further in profit, if you are now there and you lower your stop loss lower and price goes back to the stop loss, it will close your trade in a profit and protect your trade from going back to the entry point or in a loss. So as price would be lower, retail traders would lower their stop loss to to just above the recent high, and then as price would continue to come down lower, they would then also lower the stop loss just above a significant recent high. Now in the index lunch hour, if price had gone above this recent high there, we would then wait to open a sell trade from any time from the end of the index lunch hour, which will now be 5 p.m. GMT or 7 p.m. Zim time CAT. But since it did not take out any liquidity, any highs before the lunch hour, you would not open a trade on this day. And now this video is already 18 minutes, so if I try to scan every single day, that might actually make this video very long. So if I don't find a lot of days with trades, I'm just going to go to the days which actually had trades on my back test. So the open of the 4 a.m. GMT beginning of New York day is lower than the 12:30 GMT. You can see the time here. So you wouldn't have entered a trade on this day because you would have actually thought that it was going to be a bullish day, although it ended up being a bearish day. The method doesn't have a 100% strike rate. So the next Thursday to Tuesday was now 23 to 21. Okay, 12:30 candle would be above, so you wouldn't have taken any sell trades there. For red candles, remember, open will now be the top neck. Okay, for this one, 12:30 candle was below beginning of New York day, so you would look for a sell setup. Okay, so I think you can see that this is the 1600 candle, okay, beginning of New York lunch hour, index lunch hour, even though maybe their lunch is from 1 to 2, but for the markets it will be 12 to 1. So price did go up, but it did not take any highs from before the lunch hour. Okay, I'm now just going to go into the trades which I recorded in the backtest. Otherwise this video would end up being longer because it takes about 4 hours or so to do this backtest. So I'm just now checking on my records and then just going on to the profitable trades so that you just see how to recognize the patterns. But then when you want to do your own backtest, you can just do them. Now this will be a downtrend, so we'll be looking for bearish bias on the 27th. Okay, and remember those two lines, those are just moving averages which show average movement of price for the new members. And then the 1230 candle would close below. Okay, the close is there, it's below the price level where the New York day opened. So you could then continue to look for your sell setup. And now I'm going down to 5-minute time frame. Okay, so the New York index lunch hour from 4 p.m. GMT there to just before 5 p.m. it will be this candle now, the 1655, because it will end at 1659. 1700 will now be big after the lunch hour. So I'm now putting vertical lines to show you, so you can easily see if liquidity was taken out before the lunch hour. Now you can see, because this was a bearish day, price was coming down. Okay, so retail traders, when price would be lower there, they could have lowered their stop loss there, trailing it, and then if price was now down there, they could have lowered it just above there, and then here within the index lunch hour they could have lowered to just above that high. If you are still new, just watch the videos which I have on this YouTube channel for opening trades. I think it explains a bit on trailing of stop loss. So this was the most recent significant high before the index lunch hour, the period within these two red lines. Okay, and price did actually go up in the opposite direction of bias. Remember, this is bearish downward bias. So on the level above this high is where banks will place their sell trades for them to continue selling in the afternoon trend, in the afternoon session. Okay, and what I was meaning by pairing of orders in the notes is that here just above this high, okay, when price, first of all, since this is a high, if price returns to that high at that price point at the second time, people who trade with support and resistance will see it as a resistance, and they will be hoping that price will come down without going much above this blue line. And sometimes bank can drive price above that so that it then hits the stop loss of retail traders, which they would have put just above their entry point where they would have wanted to sell from. And then as price continues to go up, some traders will now want to sell, want to buy on a breakout, okay, thinking that now resistance would have now turned to support, and they will be expecting that price would now come back to the newly formed support and then continue to go up. Now banks, when price would have gone much above the old resistance, now support, they can place their sell orders there so that they will sell when those who trade on a breakout will now be trying to buy on a breakout. And then also the banks will be pairing their orders, because in the market, whenever you are buying, the market makers are selling, they are closing. And then whenever you are opening trades for buy trades, they will be selling to you. Okay, there has to be pairing of orders. You are buying and they will be selling. So also some other traders who were expecting to sell without price even gone up, some of them would have put protective buy stops. So buy stops are orders or just trades where if price goes above, they would then open buy trades, because they would have seen that what they were expecting for price to come down would have failed, and then they will now be trying to buy, hoping that maybe price is actually going to keep going up. So it's actually more of like chasing the market that they will be doing. So the banks or smart money will be placing their sell orders, okay, which will pair with the buy stops of those who now want to buy on a breakout, hoping that now the resistance is turned to support, or also those who will just open the trades, their buy trades, after having seen price coming down to the old resistance, which they will now hope will be support, and then smart money will put their sell trades there. So this is where now we also would put our sell trades there. Okay, now as long as the lunch hour would have ended, now beginning from the 5 p.m. GMT candle, from the 5 and off in EST, that will be from 1 p.m. New York time, or that will now be 7 p.m. Zim time. You can open your sell trade as long as price is at the level where orders would have begin to be paid, okay, anywhere above the area of liquidity, the high, or as long as it's above it, you can open your sell trade. But it's not safe for you to open the sell trade below there, because you are not selling where the banks would have placed their sell orders, and you actually would be at a disadvantage, because now if you sell at a lower position, you reduce the chances for your trade to actually go into profit with what you expect. So your trade might not be automatically closed in profit with your take profit. Okay. So here at the open of the 7 p.m. Zim time or 5 p.m. GMT, just at the open of the candle, you could have already opened your sell trade, sold from there, and your trade actually would have gone into profit. And there are some instances where you won't open a trade, like where I was telling you that if price does not go above a high, okay, you would not take a sell trade, like I showed you on the other day. I think it was the 30th of June. So on the 26th of April, there was also another setup there. With this one, you can actually see that obviously the 4 a.m. candle will be somewhere there, 12:30 will be somewhere there. It's lower, so you would have expected a bearish day. So now I'm going down to the 5-minute time frame. Okay, so lunch hour would have ended somewhere there and began somewhere there. So I'm just going to put these lines so those still new can clearly see. And remember, it's a downtrend and bearish bias. So this will be your lunch hour, index lunch hour. And then before the index lunch hour, you can see these highs being formed. There's another one there, another one there, another one there, another one there. As price would continue to go down lower, traders could actually be trailing, lowering down their stop loss just above the most recent significant high. So in the lunch hour, we actually see that price actually took out that high. Okay, so any trader who would have left the stop loss just above there would have their stop loss taken out, so that their trades would no longer continue to go down into profit. And now here at the 1700 GMT is the one you are going to use for back testing, so I think I'll just use that one. At the 1700 GMT, 5 p.m. GMT, price would have opened there. Okay, and it would have actually opened above where the pairing of orders would have begun, above the high. So soon as the candle opens there, you could have actually opened your sell trade. Okay, and your trade actually would have gone down into profit. And then for the next one, I have 29 March, which is in an uptrend. Okay, so I'm just putting the line there so that if I would scroll back downwards, when I reach there, I would know that that is where I would stop taking recordings for buy trades. So for 29 March, now we are looking for buy trades because now it's an uptrend, and would also be looking for bullish buyers. Okay, so I'm zooming in now so you can actually see that this was a bullish bias. Actually the 1230 candle will be somewhere there. It's obviously higher than the 4 a.m. GMT candle. So I'm now moving to 1700, then to 5-minute time frame where you take your trades. So 1600 GMT, that's beginning of your lunch hour, and then it ends on the end of the 1655 candle to be 1659. Okay, this one will now be after the lunch hour. Now this was an uptrend on the daily, bullish bias, and price overall was going up. And then before the lunch hour, you can see, okay, actually having higher lows. So as price would continue going up, they would move their stop losses there, okay, just below it. As price would continue go up, they would trail up their stop loss again. As it would continue to go up, they would trail up their stop loss. Traders, even those who are not retail traders, even institutional traders. And then during the lunch hour, price would then go down. This is the strategy which we were trading for the index lunch hour strategy. Okay, so even if this is confusing you, if you go again and read the index lunch hour strategy, it might actually help you to get sense of this strategy. Maybe also I think I can remove these moving averages, since I'm now just going down into the dates where the trades are. Okay, so price would have gone down, and during the lunch hour, during the whole lunch hour, it would have even been able to take out this low down there. Okay, it would have been able to take out this low. So below, at the blue line and below it, banks would then place their buy trades for them to continue pushing up price during the afternoon trend, the afternoon session. So this is where we would also look to place our buy trades. Now the 1700 candle here is actually below where the low was taken out there. Okay, so it's okay for you to actually take your buy trade there, but if the candle was above, it may now be a bit risky because you no longer know if price will still be able to go with the amount of pips, or just let's say distance that you would expect it to go up with. But since it already opened down there, you don't have to wait for price to go to the blue line. You can just open your buy trade. But remember, I told you in the instructions that the US 30 index did not respond well in all the trades, where for the smallest profit on the backtest to be at least the same distance or more than the biggest drawdowns. Okay, the retracement which price does in a loss before eventually going into profit. So because of that, you will be entering this strategy with late entries. Okay, so for example, if your original entry will be there, let me use a different color. If your original entry would be there at the open of 1700 candle, I was saying in the group that you would have to wait for price to retrace with about 2000, it was 2000 and something, 2032 points. Okay, 2032 points, so around somewhere there, that is where you would open your buy trades, just below, around somewhere there on the next candle. Now that is where you would open your buy trade, then eventually it would go into profit. Then the next one, 24 March. At least if I show you a number and it's still actually in the uptrend, 24 March. If I show you a number of examples, it will actually help you to recognize the patterns. So the 12:30, its close is above the open of the first candle of New York day of 4 a.m. GMT. So remember, you check your bias on the 15 but trades on the 5. And this is an uptrend on bullish bias. And if price does not retrace on US 30 index with about 2032 points, you shouldn't take the trade. So you have to be patient with this strategy. Even though a setup forms, it's not every trade which you are going to open. Okay, so here during the index lunch hour, there was a low taken out, this one with a higher low on the left and a higher low on the right. There's a swing low there. Let me use blue, it's actually easier for you to see. Okay, so price did take out a low there. You can also consider it as liquidity. So within that region, the blue line or below, banks can actually place their buy orders or buy trades. Okay, for new members, orders is also the same as trade. If you try to open a trade, it's like opening an order. Okay, that's what I mean by pairing of orders. So now at beginning of the 1700 candle, it was actually below, so your buy trade would be at an advantage because you would be expecting price to go up above where the pairing of orders began. Okay, but opening now above could put you at a disadvantage. Sometimes price might not go up with the expected amount of points that you want. And then also, I also even reminded you on the other video of the other strategy that if you look at the price units here, okay, there's a comma there, 0.33. But when I give you measurements of points to use, I would have not used commas, because when I'm doing my backtest and I measure measurements, like for example here from the open, and I measure like this, it only writes points there. I think you can see them there. It only writes points without using the comma, because this is actually the price unit, but the points are just counting the points without using the comma. So when you are now calculating what TP to use and what stop loss to use, just ignore these commas, remove these commas, and then add the points that I told you without considering these commas, ignoring these commas. Okay, so I'm now adding back the EMAs. Actually, let me just do this and just load the template. Okay, so the next one was 17 March, and here that's where you would have started to take your sell trades. And when you are at a point where a candle is just close to where the EMA is closed and you are not sure whether it was before or after, you can just use your crosshair and then actually see that this was still before the EMA is crossed. It's when they cross that you now stop taking sell trades. And then this little triangle which I used for you to set where you want MetaTrader to go in deeper on a lower time frame, if it's not appearing anyway, just try to drag it from the left corner of the screen there. But remember, if you select this option, it's going to send you to the extreme end of the screen and you won't be able to select it. So remember, this is still downtrend, okay, bearish institutional order flow, even though sometimes within these periods you can make some losing trades within there, but you just have to use them, because if you try to look at candles chasing price, you could have actually stopped taking trades there and price actually did still continue to go lower. So for 17 March, open will be somewhere around the 12:30 candle. The close is lower. Now to 5-minute time frame. Okay, so in the index lunch hour, price did go above that recent high there, that one. Okay, Okay, so maybe you actually shouldn't include this trade, because the examples that I want you to use are where price in the index lunch hour goes in the opposite direction of where price would be. Wait, let me see on the left side of the chart. Okay, so it was a day with bearish bias, so you can just still use it since this high is higher than that one. Okay, there might be some people who would have trailed from that to that lower one, so it would still be okay, because at least it was a day with bearish bias. So as price would have gone above that high, anywhere from there where the banks would place their orders or above, you could then open your sell trade on the 1700. So for this day, it was a day with a smaller profit, just from there to about there. So this is one of the reasons why you would then open your trades in a drawdown. It's like after your price would have gone into a loss with about 2032 points. Okay, and then I'm also going to show you a few examples of some losing trades, so that you can also see some of the setups which I also wouldn't want you to consider to take a trade. This one for 16 February still in a downtrend, and we would look for bearish bias. Actually, maybe let me just go to the losing trades. Let me just look for a few trades which made a loss. Okay, so there was one on 10 November 2021. Okay, so this had been an uptrend up until around the 10th of November. You can see the date there, up until the 10th of November. So it was an uptrend, and then we would look for bullish bias. Okay, so the 4 a.m. candle is somewhere around there, and then 12:30 obviously will be somewhere around there. It's higher than that. So you would have then been looking for a buy trade. Now on the 5-minute time frame, and this day there was a loss. So this was bullish bias. Price was going up, and then we would expect price to take a low within the before the lunch hour. Now, even though it did not actually really take out this low, because of the flexible spreads of brokers, because of the floating spreads, the spread can be widened and actually take a stop loss which will be just below there. Okay, that is just enough for them to even take someone's stop loss sometimes, and then you would then expect to make a buy trade. And even if price now came down, of course you wouldn't take the buy trade at the open there, because now you would taking a buy trade above where the orders would have paid at more of a disadvantage, because you wouldn't know if price would really go up with your expected points or distance. But even though if you would have opened your trade there when it came back to where the orders paid, this day there was a loss this day. And for your trades, you can open, I think, from around 1700. Even I think for the next hour is okay, even at 17:30 GMT, even up to 30 minutes after that. But especially that 1700 to 7:30, that's where the setups usually form. Another one was on 13 October. So for 13 October, it was now part of this downtrend. Okay, this candle before they had crossed over again. So in the downtrend, we would be looking for sell trades. And the bias was bearish on this day. Okay, close of the 12:30 is below. So I'm now zooming in, then going to 5 minute. And remember, this was a downtrend. Excuse me. Okay, so this was a downtrend. You can actually see price going down, making those lows. So as price would continue going lower, they would have placed their stop losses above the low. As it would go lower, they would lower their stop loss, so that if price would go up against their favor, the sell trade would be closed at the stop loss and protect some profits. Okay, and it would continue going down there, they would have placed their stop loss above there. So in the index lunch hour, price did go and take out a high there, that one. And now on the 1700 candle, it's the open is below. Of course, you wouldn't open a trade there, you would then wait for price to go up where the orders began to be paid or above where the banks would place them. Remember, they drove price up, and when you open the trade, the price just kept going up. So this day you also would have made a loss on this day. And then there's another one. The strategy does respond with about 83% success rate before you compare the smallest take profits to be the same as the biggest drawdowns. This is a downtrend, so also looking for bearish bias. Okay, I already had checked that out, so I'm now just going down to 1700. And then when you compare the strategy, now the smallest TPs to be the same as the biggest drawdowns, it will end up being around 70% strike rate. But now because you'll be entering late entries, you actually end up having even a bigger profit, because you would be entering your trades when they are in a drawdown and still wait to take your take profit from where the original entry should have begun. Now this was a downtrend. If I actually zoom in, okay, price, okay, in this case was going higher, but because it actually was a bearish day which we were expecting, price did take out these two highs. Okay, they're actually relative equal highs. Some can actually see them as a support level, relative equal highs or almost equal highs. Price would have gone above them. You can actually even use the most recent one, and then you would then open your sell trade at the 1700 candle, since it was above the where the orders began to pay on the blue line. And then on this day also price was just continue going up. I was actually hoping that I would meet a sell trade where it made a loss because of the conditions. Actually, let me try to look for a few random trades. I just want you to see where you shouldn't have taken a trade. An example of something like that. Okay, for June, I think I checked these ones with you. There's then 16 to 14. And it was a downtrend, that one. Okay, which from there you would be focusing on sell trade. (16 to 14). And then yeah, this was a bearish day. 12:30 candle is below the 4 a.m. GMT. Now on the 5-minute time frame, I hope I can see a few days where you would not be supposed to take a trade. This was a bearish day, and you can actually see price was going down, highs. And in the index lunch hour, it did take out that high. Did it take out this high? Okay, it didn't take out this high, so you wouldn't have taken a trade on this day, because at 1600, this was now beginning of the lunch hour. You can't count this candle. Okay, so the only next high was this one, and the spread for US30 isn't too big. It can't reach out to there, maybe for JP225. So on this day you wouldn't have taken a trade. And then the next day was the 15th. So you would then have to still check for buyers. Okay, so this candle, the high, the price, I'm trying to see if it's higher than that one. The high of this candle, you can see the price written there. Okay, for this one, they are equal, the highs are the same, so you can't consider it as a high. So price did not take out any high within this lunch hour. Okay, you also wouldn't have taken a trade on this day. But this strategy actually is profitable, because with the late entries, the profits will now be actually big, that you can actually compensate for, I think it was 4 losing trades, okay, out of the 24, even though you can only trade 8 trades from the, I think about 17 profitable trades or something like that, 18, I'm not sure. The profits would compensate for the 4 losing trades because you would be entering them with late entries. And this strategy is the one where I derived the index afternoon trend from, the one which I told you can trade US 500 index. I didn't make a video on that one because the instructions were simple for that one. From the 5 p.m. candle on a bearish bias, you would now just open a sell trade. If it's a bullish bias on the 5 p.m. candle in an upward trend on the daily time frame using the moving averages, you would then open your buy trade. So S&P 500 or US 500 in derivative, it actually moves well where you actually don't even have to make any late entries. But remember, backtest if you are going to use other brokers, and make sure that it also responds with the broker with the same measurements, because brokers have different sizes of wicks, even though the bodies come from the central bank side of the same sizes, but the wicks sometimes will be different. So if you have any questions on this strategy, just ask me in the group, and you can actually use it on a real account. And don't trade on NFP weeks the whole week, even the Tuesdays. Remember, you will only be using New York bias. I will update you on the actual TP and stop loss measurements on Monday after I can see the floating spreads. But your retracement will be, you enter after trade goes in a loss with about 2032 points, and then your take profit will be 2327 points from the original entry, not from your late entry. Yeah, so that's all.